Okay, so let's go ahead and let's jump ourselves into the chapter 4B discussion. 4B being that we broke chapter 4 into two parts, A and B. Part A was revenue recognition transactions. Part B is now going to be expense transactions that we're going to be looking at. Okay. Now, what makes this particular lecture sometimes a little bit of work we have to do to understand the nature of budgetary journal entries. We really have not talked about budgetary entries yet, but we're going to start that today. And that is something that is a little bit different for a lot of us because even though we may have studied preparation of budget, there was no journal entries that went along with the preparation of the budget. In governmental accounting, the budgetary entries are standardized and therefore something that we have to learn is something that would be testable, obviously in this class, in the CPA exam, etc., where you have actually standardized budgetary entries. Okay, so that's why we're going to focus on that in this chapter 4B. Okay, so first thing we need to do is start to understand certain accounts. Okay, and my highlighting for some reason got a little bit off here, so these are not strikeouts, these are underlines, etc. Okay, but we have some account names that we need to understand for our budgetary accounting. And the key that makes these budgetary account names is the word estimated. A budget is an estimate, isn't it? Okay, so you know that these are budgetary accounts because they have the word what? Estimated before them, don't they? Okay, so when a government is trying to budget what its revenue is going to be for the year, and it makes a journal entry for what it estimates its revenue is going to be for the year, it uses the account name estimated revenues, right? Estimated revenues. Okay. Now, remember that we have our revenues and then we had our things that are like non-operating revenues, and we called those other financing sources, right? Our things that are like non-operating revenues or other financing sources. What are the two other financing sources? What are the two other financing sources? Transfers in and long-term debt financing, right? Are the two other financing sources? Long-term debt and other financing sources. Good. Well, when we start the year and we're saying, well, what do we think our other financing sources are going to be? We use the word what? Estimated other financing sources because they're a budgetary account. Okay, so we've got our resource inflows, which are estimated revenues, our estimated other financing sources, right? And they are budgetary accounts because they have the word estimated in front of them. Okay, now you come over and you take a look at this next line down and notice we have something called estimated other financing uses. Our other financing uses are like non-operating expenses, aren't they? What's the one other financing use? Transfers out is the one other financing use, right? So we put the word estimated in front of other financing uses when we're talking about the budgetary account for our other financing uses. Okay? With me so far? Estimated revenue is the budgetary account for revenues. Estimated other financing sources, the budgetary account for my other financing sources. Estimated other financing uses is the budgetary account for my other financing uses, isn't it? Okay, so we're going to have to budget these things. Now, we also have an account here called appropriations. Appropriations are like estimated expenditures, but we don't call them that. The correct name is appropriation. They are not called estimated expenditures. They are called, everybody say it? Excuse me? Appropriations. They are called appropriations. Now, what happens? A government cannot spend money unless the legislature appropriates that money for spending. It is a legal authority to spend, and a government can't spend a dime unless that money is appropriated. Now, you're going to be hearing potentially in the news in the next couple of days, they're going to be saying, oh, they're going to shut down the federal government. And because the federal government is dysfunctional now, every time the budget comes due, they threaten to shut it down. And they say, well, we don't have the money to spend, so we have to shut the government down. That's a misnomer that they don't have the money. They have the cash. They're still taking the tax from your check, aren't they? So they have the cash, but they don't have the legal authority to spend the money. And if you don't have the legal authority to spend the money, you can't spend the money. So the reason they shut down the government is because they haven't passed the appropriation, because the Democrats and the Republicans can't agree as to how to spend the money, and they start calling each other names and accusing each other of all kinds of things because we want to spend the money on this, you want to spend the money on that. They can't agree, and so they threaten to shut down the government. The reason they shut down the government is they don't have the legal authority to spend if they don't have an appropriation. Okay, so a government cannot spend any money unless they receive an appropriation, and when they receive that appropriation, now they know what their estimated spending is going to be, don't they? But we don't call it estimated spending. We call it what? Appropriation. Okay. Now we also have an account called budgetary control. Budgetary control is basically where we will be reporting any deficits, any estimated deficits or surpluses. This is another budgetary account. And then we also have an account called encumbrances. We will use encumbrances anytime we order goods and some services. Anytime we order goods and some services, we'll be using the encumbrance account and budgetary control. Okay, so these are all budgetary accounts on the board, aren't they? They're on the screen right now. Okay, estimated is a key word that is budgetary. Estimated revenue, estimated other financing sources, estimated other financing uses, all budgetary accounts. The appropriation is a budgetary account. It's sort of like estimated expenditures, but we don't call it that. We call it what? We call it appropriation, right? And then we have our what? We have our encumbrances and our budgetary control. Okay? All right, so these are just the account names right now, guys. And what we're going to do is go ahead and work with each one of these, starting with this slide right here, which is showing you the budgetary entry that you make at the beginning of the year when you're approving your budget, okay, when your budget is approved. So we go ahead and we debit our estimated revenue. We debit estimated revenue. We credit the appropriation for the amount of the appropriation we got, and the difference between our revenues and our appropriations, our revenues and our estimated expenditures, goes to this account called budgetary control. Okay, so this government has estimated revenues, and remember, our revenues are based on our revenue recognition rules, so there might be some property taxes in here. There might be some estimated license fees, whatever, all of our different categories of revenue. And you can see that they have given us some of the detail at the subsidiary ledger level down here, the subsidiary level down here. They've given us the detail. These numbers total up to $500,000. Okay. In this class, I'm only interested in your ability to make the GL level journal entry. So I'll tell you the government received 500,000 of estimate, or is going to receive 500,000 of estimated revenues. What's the budgetary entry? Debit estimated revenue. Credit the appropriation. This is how much money they were told they could spend, and then the difference between what they think their revenues are going to be and what they're told they can spend gets credited to budgetary control. So this government is planning to have a surplus, aren't they? They're thinking there's going to be some left over, and they credit that to budgetary control. Now, you take a look at this, and what happens if the government determines that it's going to spend more than it is receiving in revenue? Say the revenue was $450, but the appropriation is what? $500,000. Then they will have a deficit, won't they? and the debit will go to budgetary control instead of the credit being to budgetary control. Now, could this ever happen? Could the government ever have a deficit? They do it all the time. You hear about the federal government's deficit all the time, right? We're talking state and local in here, but the federal government is famous for its deficits, right? And you have deficit after deficit after deficit after deficit after deficit after deficit after deficit, and all of a sudden you have a debt of some $23 trillion, whatever it is. $23 trillion. That's the accumulation of year after year after year of deficit. And you sit there and say, oh, gee, poor government, they ran out of money. No, they planned. They prepared a budget, a legal budget, that said they will spend more than they take in. They sat there and they thought their way through it and said, we're going to spend more than we take in. And they do that every year. Okay? Now, this is why it is dumb when they talk about the debt ceiling. You ever heard of the debt ceiling? Debt ceiling says that the debt can't go over a certain amount. And they'll set that debt ceiling, I'm not sure what it is right now. Let's say the debt ceiling is, just for fun numbers' sake, let's say it's 27 trillion. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That's the debt ceiling. Now the current, and I'm just making that number up. I'm not sure what they said that the ceiling was, but this is just for illustrative purposes. Now the current debt is what? 23 trillion, we're saying, give or take. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Then they go ahead and they pass a budget. They pass a budget, and that budget says that there's going to be a $5 trillion deficit. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay? They set that deficit up. Now, what happens? They're obviously going to be spending, and they're going to have this deficit, and eventually the deficit's going to put them what? Over the debt ceiling, isn't it? Now, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So as they're spending and getting closer and closer to that debt ceiling and they're getting ready to go over it, they get closer and closer to the debt ceiling, then they start saying to you, we're going to go over the debt ceiling and we're not going to do this. We're not going over the debt ceiling because that's not right to go over the debt ceiling. And they want to go over the debt ceiling because they just don't care about the ceiling. They did this to Obama every single time. And they made the man drag himself through the mud to say, you got to raise the debt ceiling. If you don't raise the debt ceiling, the federal government will default on its debt. And if it defaults on its debt, that's financial calamity. I don't know what happens if the federal government defaults on its debt. I do know that your finance class will have to rewrite their books because they have the risk-free rate of return, which is tied to whatever the return is on treasuries. But how can you have a risk-free rate of return if the entity defaults on the debt? Nations look to put their short-term cash into treasury securities because they know that it's not going to default. So the financial markets around the world would be in turmoil if they defaulted. So they're playing a political game with you. They're sitting there saying, oh, we're getting so close, we're going to default. I don't know, you guys aren't responsible that we're going to go over the debt ceiling. Meanwhile, they had already passed a budget that required them to go over the debt ceiling. They knew it. They knew it when they passed it. And then just waited for the political theater to wait to see when they got up this close so that they could sit there and hypnotize you into thinking something that they want you to think. Okay? So when you hear that debt ceiling talk, you should sit there and say, here they go again. They're playing with you. They're messing with you. They're treating you like a fool. Okay? All right. Now, anyway. Yes, sir.
So what's your opinion about, like, if the debt just continues to increase, like what would be some solutions, or is it feasible for it to just, exponentially just continue forever to increase?
It is not feasible for it to continue exponentially forever because what the big real problem with the debt is the debt service. You have to pay the interest. You have to pay the interest on the debt. That's problem number one. Problem number two is what happens if you throw a debt issuing party and nobody comes. Okay, they're going to have a problem that at some point, if individuals that buy the Treasury securities back away from that because the debt ratio is getting so high, they'll have a problem. They will absolutely default on the debt because they need to issue more debt to pay the debt that's maturing. So they're going to have that problem as well. So they're going to have to get it somewhat under control. Now, if we have a deficit, that means that our revenues are not enough to cover our expenses, right? So we're either going to have to raise revenue or cut the expenses, or a combination of both, right? Okay. Do you think they're going to raise revenues? They just got done cutting revenues. They increased the deficit with this great tax cut that you're only getting true benefits from the tax cut if you were going to inherit $11 million. If you're going to inherit $11 million, yes, they cut your taxes, okay, significantly. If you weren't going to inherit $11 million, they did not cut your taxes. In fact, in California, they raised our taxes so they could cut taxes in other states that vote for the Republicans, essentially, because they're the ones that cut the taxes, right? So they're not raising revenue. I guess they want to cut expenses. What expenses should they cut? Defense. They're not cutting defense. They're increasing defense. They just got done increasing it. Okay, so then you have entitlement programs like Social Security. So I guess what they're going to want to do is take all the old people like me and take us out somewhere and just leave us out there, okay? Round us up, take us to the desert, and just leave us there and say, okay, good luck, don't take any more money, right? That would be a good way of cutting the expenses, I guess, right? They could cut, aid to state and local governments. Okay, if they cut aid to state and local governments, your tuition's going to go through the roof because some of that money is used to subsidize the state university system, etc. So it gets really hard to figure out what there is to do, the best way to do it. I'm of the opinion that they're going to, at some point, have to raise revenue. They're going to have to raise the taxes at some point. That's my belief. Okay, but I don't know. Maybe they'll figure out some other way of cutting these entitlement programs, etc. The good news about entitlement programs is eventually we will die our way out of that problem. And by dying our way out of that problem, what? I'm 56. Let's say I'm lucky enough to live to be my dad's age, 88. I'll just give myself that, which, by the way, I'm not going to make it to his age. But anyway, so that's 32 years. Okay, so in 32 years, I'm almost dead, let's say. Okay, let's say I'm dead, whatever, in 32 years. Okay, so in 32 years, I'm at the end of the baby boomer generation. So in about 32 years, 30 years, whatever, people my age will be dead, and we'll have the situation there won't be so many people trying to collect their Social Security benefits and stuff while there's less young people working, right? And so we will die our way out of that problem eventually, but we have to die first. So what I tell my friends that are around my age, they say, well, they're not going to pay us our benefits till we get older because we live longer. Okay, and I'm like, okay, if you take a room of people my age, take a room of people your age, you'll probably all be here in 10 years. You take a room of people my age, there's a chance that maybe 10, 15, 20% of them won't be around in 10 years. So if they raise your retirement age, what they're telling you is they want you to die before you collect your benefits. That's what they're telling you. Okay, so anyway. All right, so we will eventually, that's what I tell my friends anyway. That's why I don't have many friends. Okay, so what happens? So we sit here and we have these surplus. In this example, we credit budgetary control, but you could have what? A deficit, in which case you would debit the budgetary control. It's one or the other. They're mutually exclusive. Okay? So here we're using our budgetary accounts, debit estimated revenue, credit appropriation. If you have a surplus, credit budgetary control. If you have a deficit, debit budgetary control. Okay, and I'm only interested in your being able to handle this GL level journal entry. I don't care about the subsidiary level detailed information. Okay, now you start feeling a little bit creepy with this thing because you're sitting there and saying, wait a minute, you're telling me I debit a revenue account? That's weird. Okay, so let's just go ahead and take a look at what happens with that debit. And so I put our revenues ledger. I struck out the word subsidiary because I was just using something the book had, and I don't want to get into the subsidiary, but I wanted to use this table. And so we have our what? And for some reason, it wouldn't let me change that word subsidiary. So revenues ledger, and I debit my estimated revenue, don't I? Was an estimated revenue a debit? I pick that debit up and I stick it right there. And now the balance in here is $500,000 debit, isn't it? Okay. Then what happens? Then I go ahead and I have my actual revenue. I don't know, I issue some fishing licenses or something. So I get cash of $40,000, I credit revenue of $40,000. I've met my revenue recognition rules. I pick up that credit and I stick it right here, don't I? And when I stick it in there, now the balance in the revenue ledger is $460,000. So the government knows that it has what? $460,000 left to go to collect what its budgeted estimated revenues are. A little while later, I do what? I issue some more fishing licenses, whatever. I don't know. I get some cash for my, services, whatever. I debit cash. I credit revenue $50,000. I stick that credit in the what? In the revenues ledger, and now I know I have what? $410,000 to go. So the debit to estimated revenue sits there as a placeholder all year as we have our what? Actual revenues, which are credits, and then we go ahead and can see what we have left to go. Question on that? Okay, good. Now we also did what? We credited appropriation, and appropriation was sort of like our estimated expenditures, wasn't it? So we're crediting expenditures. Why? Because we're going to sit here and we're going to have our actual expenditures and our encumbrances be debits, and they will balance off against the credit to appropriation. So anytime a government orders goods and many services, it has to make a formal journal entry. Now, this is different than anything else you've talked about in your accounting classes here at San Jose State. We have not talked about formal journal entries that you have to make for ordering things. In a government, we have to make a journal entry when we order things because we are not allowed to overspend our appropriation. And if we went nuts just ordering all kinds of things crazily, we might what? Potentially exceed our appropriation, and we wouldn't realize it. If we waited until the stuff was delivered, we'd go, oops, geez, who ordered all this stuff, right? Now we've exceeded our appropriation. So to avoid that problem, we don't want to overspend our appropriation. If a government overspends its appropriation, there's something called anti-deficiency laws that will hold the government officials personally liable for fines if they overspend their budget. They don't make them say, hey, you overspent, $10 million, so give us $10 million. But they would sit there and they would hold them personally liable for a fine. They would actually be fined for doing that. So governments do not want to overspend their appropriation. So anytime they order things, they debit encumbrance, they credit this account budgetary control. Debit the encumbrance and credit budgetary control anytime you order these goods. Now what happens? A little bit later, the goods come in. When the goods come in, you will reverse the original journal entry by debiting budgetary control, crediting encumbrance, $50,000 in this example. Guys, what is all this all of a sudden break time here in the first 10 minutes of class when I'm talking to you about stuff that you absolutely have to know? I mean, there is no way to get out of this class without knowing this stuff. So I don't quite understand this. Let me take a break right while I'm in the middle of explaining something to you that's like kind of the core of the whole class here. That didn't seem to stop him, but anyway, okay? So what do? You go ahead and you debit the budgetary control, credit the encumbrance, reversing the original encumbrance entry, and you debit expenditure and credit vouchers payable for the actual amount, whatever that is. Now, vouchers payable, I wrote across there, is like accounts payable, but we call it vouchers payable. But it's just like accounts payable. The only reason we use the term vouchers payable is that in government, expenditures always have to be approved. So they'll list a set of expenditures on a voucher. Somebody will approve that voucher. See how I signed on that voucher? Somebody will approve that voucher, and that just proves that that expenditure was approved, right? And so we call it vouchers payable, but from an accounting standpoint, it is a liability. It is no different than accounts payable, but we don't call it accounts payable. We call it what? Vouchers payable. Okay? Now, if you look at this process, we debited encumbrances, credited budgetary control. That was when we ordered the stuff. When the stuff came in, we did what? Debited budgetary control and credited encumbrance, reversing the original entry and replacing it with what? The actual expenditure by debiting expenditure and crediting cash. Okay? So when you take a look at this thing right here, this is an appropriations ledger. And remember when we set up the journal entry at the beginning of the year, we debited estimated revenue for $500,000, credited the appropriation for $450,000, credited the budgetary control for $50,000. I'm just showing you that entry again. We already showed you that one earlier, beginning of the year entry. Okay, and then what? We put that credit into the appropriation, so we have a credit balance in there, don't we? Then when we ordered the goods, we did what? Debited encumbrances and credited budgetary control. When we stick that debit into encumbrances, notice the balance in the appropriation account goes down to $400,000. So if somebody walked in and said, hey, let's go wild and let's order stuff in the amount of $480,000 or something, we'd say, stop, we can't do that because we only have what? We only have $400,000 available in this appropriation. A little bit later, what happens? The actual item comes in, doesn't it? And when the actual item comes in, we reverse the original encumbrance entry by debiting budgetary control and crediting what? Crediting encumbrance, didn't we? Okay, and when we did that, then we went ahead and credited the encumbrance. For a second, the balance went up to $450, didn't it? But then we put what? The actual expenditure in there of $50,500. And when we put that debit in there, that brought the balance down to $399,500, didn't it? Okay, so you set up your encumbrance for what you think you're going to have to pay for that thing you ordered. They thought $50,000. They stuck that in there. They knew that they couldn't spend any more than $400,000 after that, right? When the thing came in, okay, it came in a little bit different, didn't it? A little bit more. That's okay. You simply reverse the original encumbrance entry and then do what? Bring in the actual expenditure, and that expenditure takes the place of the encumbrance, doesn't it? That expenditure take the place of the encumbrance? Okay. Now sometimes students will say, well, what if it comes in a lot different? Then we're going to fire our purchasing person, because that person should pretty much know what the amounts are that are going to come in. I mean, they shouldn't go wild and say, geez, oh, heck, gee, I only thought that thing was going to be 50,000 and it's 50 million. Oh, my bad. Okay, expectation is that it should come within a ballpark figure, so we're pretty close and we're not going to overspend our appropriation. Question? Okay, good. So what's the journal entry when you order goods? Debit the encumbrance, credit the budgetary control, right? When the stuff comes in, you do what? Reverse that for whatever you had set it up for. I don't care what the stuff comes in for, what the actual expense is. You reverse it for the budgeted amount, don't you? Debit the budgetary control, credit the encumbrance. and then debit expenditure, credit vouchers payable or cash, I guess you could pay cash, for the actual amount, right? Okay, good. And by doing that, in our appropriations ledger, we're making sure we're not overspending our appropriation. Okay? Okay, good. Now you come over and here's that dual track thing again. Everything gets recorded at the budgetary level, and then what? We convert, consolidate up to the government-wide level. Okay. Okay. So let's look again at some of these journal entries. This is the beginning of the year journal entry in which we do what? We debit the budgetary control. We debit the estimated revenue. We credit the appropriations, and if it's a deficit, we do what? Debit the budgetary control. If it's a surplus, we do what? Credit the budgetary control. And you make this entry at the beginning of the year. Now, at the end of the year, we will simply reverse this. At the end of the year, we're going to reverse this entry. Okay? But let's just go ahead and let's take a look at our encumbrance accounting. Okay? Nothing new on these slides, guys. We sit here and we do what? We debit the encumbrance, credit the budgetary control. When the stuff comes, I don't care about the subsidiary ledger. That's why that X is there. I don't care about subsidiary ledger. It's all what? Summary GL ledger level. This is the details, isn't it? I don't care about the details. I just care, do you know that if I tell you you had something that was ordered for 420, debit encumbrance, credit budgetary control for the 420? I don't care about the details in the subsidiary ledger. Okay? Don't make me come by and see, make sure you're looking at governmental accounting. If I see any signs of happiness on your face, I know it's not governmental accounting. Yes, sir.
I'm having trouble finding this slide specifically. The other one before that.
It's number 11. It's on part B.
Oh, part B. Okay.
Yeah.
There's 4A, there's 4B. 4B is the expense part. Okay. Okay, great. Okay, now what? Now, when the thing comes in, it comes in at an actual amount of 432. So what do? Reverse the original encumbrance entry and do what? Set up the actual expenditure for the actual amount. Okay. Okay, good. And again, if we were recording this at governmental activities level, instead of just calling it expenditures, we would go ahead and call out the programs. Remember, we take a programs approach at the government-wide level. So we'd say whether it's remember public safety was a program, whatever it was for, again, credit vouchers payable. That's the same at both levels. Okay, now before I get into this accounting for payroll, I want to go back and talk to you a little bit about budgetary control. Because budgetary control is kind of a weird account to understand. Okay? Now, I'm going to go ahead and tee up Bud Control here, which, by the way, you see it right here. I've also teed it up there. Okay? And when I teed it up, I'm going to follow to see what happens to my budgetary control account. Okay? Now, what happens? Let's see if I can bring this down a little bit. If I have it down too far, it blocks the screen. But I think it'll work like this. Okay? So at the beginning of the year, I do what? I debit estimated revenue. I credit appropriation 450. I credit budgetary control. You can't quite see it here, but use your imagination. 50,000, right? Okay. So I go ahead and I credit my budgetary control 50,000. With me so far? Okay? Then what happens? Then I go ahead and I order some goods, don't I? And when I order the goods, I went ahead and debited my encumbrances for 50,000, right? And I credited budgetary control for 50,000. So there's another credit to budgetary control, 50,000. With me so far? Okay. And then what happens? When the goods come in, I do what? I reverse the original encumbrance entry by crediting the encumbrance and debiting the budgetary control, debit expenditure, credit vouchers payable for the actual amount, don't I? So I went ahead and I credited budgetary control for 50,000. Debited. I wrote it on the debit side. I said credit. Thank you. Debit budgetary control for 50,000. With me so far? Okay, now that beginning of the year budgetary entry sits there all year, doesn't it? As a placeholder against my orders, my appropriations. The 450 credit sits there all year. The debit to estimated revenue sits there all year as a placeholder against my actuals, don't they? At the end of the year, do you close all your revenue and expense accounts in accounting? Do you close all your revenue and expense accounts in accounting at the end of the year? Yes, you do. So you're also going to close all your budgetary revenue and expense accounts at the end of the year, aren't you? I don't need them anymore because the year's over. So since I'm going to close them at the end of the year, right here, guys, where I put these couple little stars up there, at the end of the year, I simply reverse the beginning of the year entry, don't I? I just reverse it. I debit the appropriation for 450,000. I credit the estimated revenues for 500,000. Did I close those? Are those all closed? Those are all closed, and since I'm reversing it, now, of course, I'm going to debit budgetary control, right? Because I reversed the beginning of the year. Beginning of the year, I credited it. End of the year, I debited it. So that's why I drew this like this before, in that budgetary control is sort of like, what is this? What is this? Like a horse? Okay, what happens? You sit there, and when you're taking the journey at the beginning, you put a bunch of stuff on the horse, don't you? By the time you get to the end, you take everything off the horse. That's how budgetary control works. You put what? You put the amounts in at the beginning of the year for what you think you're going to have as a surplus, whatever, or deficit. If it was a deficit, you would debit it, right? What you think your surplus is going to be. You go through the year. At the end of the year, you reverse that out, don't you? During the year, you do what? During the year, you order goods, don't you? During the year, you order goods. When those goods come in, don't you reverse everything? So by the end of the year, budgetary control will always go back to zero, won't it? Just like my estimated revenue account will go back to zero, my appropriations will go back to zero. Closing entries in accounting, your revenue and your expense accounts go back to zero, don't they? Okay. All right, good. So let's do a little testing here. Let's see where our understanding is here today. So what's the journal entry to record the budget at the beginning of the year? Sir? Journal entry to record the budget at the beginning of the year. Journal entry to record the budget at the beginning of the year. Journal entry to record the budget at the beginning of the year. Yeah, beginning of the year, budgetary entry. What do you do at the beginning of the year to record the budget? Go ahead. He's pointing to the slide that has it. Beginning of the year. Beginning of the year to record the budget. Beginning of the year. Debit estimated revenues. Debit budgetary control. We have a deficit. Credited if we have a surplus. And credit appropriation. I'm telling you guys, you tune out on this stuff, and you're going to be sitting there, and I'm going to be going over quiz questions here in a little while, and you're going to be going, Gee, he didn't explain that to us. Because you tuned out. You cannot tune out on this stuff. You tune out, it's going to roll you. I promise. So what's the journal entry at the beginning of the year to record the budget? Debit, credit, and if we have a surplus, credit, budgetary control, right? Okay, good. What's the journal entry to order goods? Debit, encumbrances, credit, budgetary control. Good. What is the journal entry when the goods come in? Reverse, debit the budgetary control, credit the encumbrances for the original amount, debit expenditure, credit vouchers payable for the actual, right? Okay, good, good. What's the balance in budgetary control at the end of the year? 0, good. What's the journal entry at the end of the year for your beginning of the year accounts? Your appropriations, your estimated revenues. We reverse them. They're also zeroed out at the end of the year, aren't they? Okay, good. All right. Now, you come over and you take a look at accounting for payroll. Now, the book slide that I'm using here gives us way more detail about payroll than we need to worry about. I'm not going to teach you payroll in here, okay? I don't even teach that in Accounting 100. Okay? You want to learn about payroll, go to community college, okay? They'll teach you everything you ever want to know about payroll, okay? So I'm not going to get into the details of payroll, even though the slides show it. The key thing that I want you to understand right here from this slide is that if you have a recurring expenditure like payroll, does payroll happen on a schedule? Okay? You don't have to use encumbrances. If you have recurring expenditures, they don't make you record the encumbrance. You simply debit the expenditure, credit the cash or whatever for recurring expenditure like payroll. Okay? So let's just take a look at what they did here and notice they went straight to expenditure. And then they have what? Withholding for your federal tax, withholding for your state tax. And then the cash is the difference that goes to the employees, right? That's your net pay. Okay, but notice it went straight to expenditures. Now, I do have in red up here, underlined. Do you think that's important? Underlined red. Okay, I do have 2 account names up here due to federal, due to state government. Okay, now hear me on this. When one government owes another government money, they call that account due to. So the state, whatever this is, county, city, government owes the payroll withholding to the state and to the federal. Since it's due to another government, they call it, everybody, due to. Due to. It's not accounts payable, it is due to. Okay? So that's the 2 takeaways from these couple of slides. That's all I care about, that you understand that if you have recurring expenditures like payroll, we don't have to encumber first, right? And if one government owes another government money, we call the account what? Due to. That's the only thing I want you to take away from those 2 slides. Okay, good. And here it is at the government-wide level. Again, just calling out the expenses by program. That's all. Public safety, for example. No real difference there. Okay. Governments can borrow money. They borrow money sometimes from a local bank or something against their future tax collections. They call that tax anticipation notes. Tax anticipation notes. Abbreviated TAN. Abbreviated TAN. So Jordan, are you tan from the sun?
A little bit.
Hi, I'm John from the Earth. Nice to meet you. Okay. All right. So tax anticipation notes, okay, TANs. And what these do is it's a short-term borrowing, and a bank is willing to give them this money because they know that what? They're going to collect taxes and they'll be able to pay it back pretty soon, right? Okay. The key takeaway here is that we do credit this what? Tax anticipation note payable. This payable amount, it is a short-term liability. That's all I want you to take from this slide. Is that a tax anticipation note? It is a liability, isn't it? In our governmental funds, can we have current liabilities? In our governmental funds, can we have current liabilities? Okay, if you guys don't get it right, I'm going to laser my eye out. In our governmental funds, can we have short-term liabilities, current liabilities? Current assets minus current liabilities equals fund balance, guys. You got to be looking at those previous lectures. When we talked about the balance sheet for the governmental funds, it was current assets, it was current liabilities. It was the long-term assets, the long-term liabilities that don't show up for our governmental funds, right? Right? I mean, come on, guys. That's the baby part of this class. Okay? All right, so this is a current liability, isn't it? That's all I want you to understand about that slide? Okay. Okay, good. Let's look at this one. It looks worse than it is. Don't worry. Okay? So what happens? We have money that is going to go between the funds. The funds will pass money back and forth to each other. Okay? Now what happens? Those passings of money are going to fall into three categories. They're either going to be interfund loans, they're going to be interfund transfers, or they could be transactions between the two funds, and we'll talk about that on the next slide. But let's talk about these two right here first. Interfund loans. If somebody loans you money, are you supposed to pay it back? Yes, you are. So if one fund loans another fund money, the idea is that the borrowing fund will pay back the lending fund. So right here, do you see balance sheet, BS? You see balance sheet? So the general fund did what? Loan $10,000 to the capital project fund. In the general fund, we will debit loan receivable, $10,000. We'll credit cash $10,000 because that money is going to be paid back, isn't it? So we have a loan receivable. It's purely a balance sheet effect. Okay. In the capital project fund, we will debit the cash and we will credit loan payable, which is a liability, isn't it? Is loan payable a liability? Don't make me start talking to you guys the way I talk in my Business 20 class. I have to say loan payable. Is it a liability? Okay. All right. So, okay. When I first started teaching, of course, I taught the CPA exam for years. And when I first started teaching introductory to accounting, I had students ask me, what's a liability? I don't understand what a liability is. One time a student asked me, what's a debit? And I went, I can't speak to this creature. How can they not know what a debit is? Okay. So you don't know what a pleasure it is that I can speak to you, okay? So what happens? We sit here and we do what? We debit cash, credit loan payable, because the capital project fund has to pay that money back, don't they? Okay, so that's one way money can be transferred over is through loans. You could also have interfund transfers. So if the general fund is going to transfer money to, say, the capital project fund with no expectation that that money is going to be paid back, again, of course, we still credit in the general fund, we still credit cash for $10,000, don't we? We still credit cash for $10,000. But now the debit is not to accounts receivable or loan receivable. The debit is to other financing uses. What's the one other financing use? Transfer out. Other financing uses transfer out $10,000. That appears on the statement of revenues, expenditures, and change in fund balance, doesn't it? Where on the statement of revenues, expenditures, and change in fund balance does it show up? The top? A little lower? A little lower? It shows up where? On the bottom, doesn't it? It's like in the non-operating section. We have revenues minus expenses. That gives us the account name called revenue in excess of expenditures. I always wonder why my students have trouble with that account. We say, which of the following would be on the statement of revenues, expenditures, and change in fund balance? And we have revenues minus expenditures is called the excess of revenues over expenditures. Hello? Revenue minus expenditure is going to give you an operating income item, revenue in excess of expenditures. Then we keep going into what's like the non-operating section, other financing sources and uses. And if the general fund had transferred money to the capital project fund on their statement of revenues, expenditures, and change in fund balance, which is like their income statement, we would show other financing use transfer out 10,000, wouldn't we? Which is this debit here. Right? Of course, the capital project fund is receiving money, aren't they? That they're not going to have to pay back. So it's kind of like income, isn't it? But we don't call it income. We call it an other financing source. There are two other financing sources. What are they? What are they? Huh? What are they? Transfer in and what? Long-term debt proceeds are the two other financing sources. So since the capital project fund is getting money transferred in, we would credit what? Other financing sources. That'll show up on the bottom of their income statement, won't it? On their statement of revenues, expenditures, and change in fund balance. Question? So we got two ways of getting money between the funds, loans and transfers so far, right? The other way that we will get money transferred between the funds is when one fund provides a service to the other fund. One fund provides a service to the other fund. So what happens here? I'm circling this fire hydrant because what? Do cities use water? The city could use water just like what? Just like the public will. Okay? Or we could have what? A service being provided by the internal service fund. Do governments have vehicles? Yes, they do. And they take those vehicles to be worked on where? In the internal service fund motor pool. And the general fund has to pay the internal service fund for that service, don't they? Okay, so what would happen? In the general fund, we would debit expenditure 5,000, credit, say, due to internal service fund for 5,000. In the internal service fund, they'll do what? They'll debit, and here's another new term, due from. So when one fund is going to receive money from the other fund, we call that due from. When one fund owes another fund, we call that due to. Due to, due from, right? Okay? Okay, good. So what happens? In the internal service fund now, they'll debit due from the general fund. They'll credit revenue because they provided a service, won't they? Same thing if what? If it's an enterprise fund. I wrote enterprise fund here. If it's an enterprise fund and the government is purchasing, the general fund, I should say, is purchasing water from the enterprise fund. In the general fund, we'll debit expenditure, credit what? Due to now what? Enterprise fund, because water is paid for out of enterprise funds, aren't they? And in the enterprise fund, they'll debit due from general fund and credit the revenue for the water service that they're providing. So really the same journal entries, whether it's the what? Internal service fund or the enterprise fund here. Is money going between funds? Is money going between funds? Yes, it is, but now this is our third category where there's been an exchange transaction of services, hasn't there? Okay, so again, all we're talking about on these couple of slides is money going between the funds. It can be what? Loans, in which there's going to be a payback of that, right? It could be transfers, in which there's no expectation that there'll be money paid back, right? Or it could be what? It could be transactions, exchange transactions between the two funds that will cause the money to go over. Question? Okay, good. Let's talk about accounting for inventories after this break that we're going to take. And I'm saying that because I don't want to pile more on the brain right now than would be prudent. So, any questions about anything we talked about so far before we run out? Okay, let's go ahead and come back at. I'll give you a 12-minute break. Come back at 10 after, and we will go ahead and pick up the accounting for inventories example. No, we're not going to skip it. Yeah, I just decided I want to do inventories first, and then we'll come back and we'll do the yeah. Oh, was it? Okay, thank you. Yeah, I always put it on vibrate. I have a feeling it's probably my dad or my sister. Huh? My dad lives with me. Thank you. Thank you very much. I don't have to drink the San Jose water now. My dad lives with me. My sister lives in Folsom. Sort of near Sacramento, the middle of nowhere. Folsom. She married somebody and she lives up there now. She moved out of the sticks, but. Oh, it's worse in the Bay. Traffic is worse in the Bay Area. Yeah, I mean, you probably hit certain patterns. I guess I should pause this. Okay, and we are going to talk about accounting for inventories for this government. Now, for government accounting, for our governmental funds is what I'm trying to say. Now, is inventory a current asset? Is inventory a current asset? Yes, it is. And so we're going to have to make sure that we show inventory on our balance sheet. And there are two methods that GASB allows governments to use when they are accounting for their inventory. Okay, one is called the purchase method, which is consistent with modified accrual accounting. The other is called the consumption method, which is a little closer to accrual accounting. But for our governmental funds, we can use either of these methods. Either of these methods are acceptable. Purchase, consumption. Two methods, both acceptable. Okay? Now, we're going to see that there are obviously differences between these two methods, but one of the first takeaways I want you to get in your mind here is that as far as the balance sheet presentation of inventory is concerned, there is no difference between the two. Inventory will be presented on the balance sheet the same way regardless of the method. First takeaway. Second takeaway is that the difference is how we show these on the statement of revenues, expenditures, and change in fund balance. So the impact of the difference is on the income statement depending on which method you use. Okay? Now you come over and you take a look at the specific transactions and journal entries, and rather than read through and try to explain to you the horrible example that the book had for us, I'm going to go ahead and I'm going to show you this example right here, which is on Canvas. So the same example is on Canvas, but I have it right here up here on the screen right now. Okay, and we have the two methods, which is the purchase method and the consumption method that we'll be talking about. With me so far? Purchase method, consumption method. You see the two methods here? Okay. So let's go ahead and let's take a look at this first highlighted thing. And I say balance sheet before the purchase of an inventory, both methods. So both methods, we would have the balance sheet look the same. Before any purchase of inventory, this government has $100,000 cash, no liabilities, and we're calling the entire $100,000 unassigned fund balance, meaning they can use it for whatever purposes, right? Okay, now, under the purchase method, right here, guys, under the purchase method, how do I want to do this? Draw. Right here. Under the purchase method, okay, when we purchase inventory, can I sit down? I'm going to sit down. I think it's a little better. And I'm not blocking the screen, one, and I'm not sitting here over here like a drunken sailor hanging over the thing. Okay, so I'm going to go ahead and sit down. I think you can still hear me, right? Okay. All right, so what happens? Under the purchase method, when I purchase inventory, I debit expenditure and I credit cash. That's why they're saying that's consistent with modified accrual accounting, because when I purchase things in a modified accrual accounting, I debit expenditure, don't I? This is not a good time to bother the person next to you. So we go ahead and we debit expenditure and we credit cash, right? Okay. Now, immediately after that purchase, under the purchase method, notice that what? I obviously don't have any cash. I'm still showing an unassigned fund balance because I haven't made any entries to that account. So for a second, the balance sheet is out of balance, isn't it? Just like any balance sheet is out of balance before you do your closing entries, in which you've had an expenditure of some sort, right? Okay. Now, what happens? I go ahead and I use up $45,000 of inventory during the year. Under the purchase method, there is no entry. I do nothing for the use because I've already recorded it all, $100,000 of expenditure, haven't I? So there's no journal entry when you actually use the inventory. Okay? Now, I come down under the purchase method, and I go ahead and I make up my statement of revenues, expenditures, and changes in fund balance for the purchase method. And assuming that was the only transaction, I would have revenues of 0. I'd have expenditures of 100,000, wouldn't I? And I'd have a change in fund balance, which is this negative, like a loss, 100,000. Okay? Okay, good. Now I go ahead and I do my closing entries. And when I do, I debit the unassigned fund balance for 100,000, credit the expenditure to close my expenditure accounts like closing them out to retain earnings, right? Okay. And so when I prepared the balance sheet, well, hang on a second, guys. I'm not ready for the balance sheet yet. And then I go ahead and I establish the inventory on the balance sheet. So if I had 100,000 and I used 45, how much inventory is left? $55,000 of inventory is left, isn't it? Started with 100, used 45. So I simply debit inventory for 55,000 to bring it on the books and credit non-spendable fund balance. Remember we said that the amount of your inventory must match the amount of the non-spendable fund balance? If they drop an atomic bomb, the last thing the governmental accountant's hand does is reach out from the rubble and make sure that the inventory account balances with the non-spendable fund balance for inventory. Those numbers always have to match. Do they match? Do they match now? So when I prepared the balance sheet, I have what? My cash is 0 now because I credited cash, didn't I? My inventory is 55,000. My unassigned fund balance is now 0 because I what? Closed it out when I did the expenditure. I debited the unassigned fund balance and credited the expenditure. So that's now 0. And the non-spendable fund balance is showing 55,000. Is it supposed to show 55,000? Isn't that beautiful? This is why you studied accounting. just for these beautiful things like this. Look at this. Okay? All right, now that is the purchase method. The consumption method, they said to us, is more like modified accrual, didn't they? I mean, full accrual. Okay, so let's take a look at this. Under the consumption method, when I purchase inventory, I debit inventory and I credit cash, don't I? Now remember, both balance sheets started out just showing cash of 100. Under both methods, the balance sheet started out showing cash and unassigned. But immediately after purchasing that inventory, my cash is 0, my inventory is 100,000, and my unassigned fund balance is 50,000, isn't it? I mean, not 50,000, but 100,000. With me so far? Now, don't we have to have a matching between my inventory account and my non-spendable fund balance? Don't we have to do that? Isn't there supposed to be a match between my inventory and my non-spendable fund balance? Is it matching right now? It is not matching right now. So under the consumption method, what I'll do is I'll debit inventory for 100,000. I'll credit cash for 100,000. I will then debit the unassigned fund balance for 100,000, credit non-spendable fund balance for 100,000, and when I do, my balance sheet will now show what? Show inventory of 100,000. My unassigned fund balance will now be what? 0, and my non-spendable fund balance will be how much? 100,000. The world is perfect. Non-spendable equals the inventory. Right? Okay. Okay, good. Then what? Then I go along and I use some inventory. And we said in this problem I used 45,000, didn't we? So unlike the purchase method where I didn't make a journal entry, in the consumption method I debit expenditure 45,000, credit inventory 45,000. That's pretty easy. That's what you would do if you used up inventory under full accrual accounting, wouldn't you? Credit the inventory, at least under the perpetual method, I should say. Okay, and so when we look at the adjustments made during the year as we use inventory, same entry, guys, I just showed you, debit expenditure, credit inventory. When I credit inventory, is it showing 55,000? That's what it's supposed to show, isn't it? 55,000, that's what's left. I had 100,000, I used 45. When I credit the inventory account for 45, it comes at 55,000, doesn't it? At the same time, I go ahead and I do what? I credit the, well, let me do the debit first. I'll debit the unassigned right here, and that'll bring the balance down to 55,000, won't it? So the balance sheet is perfect right now. The inventory shows 55,000 and the non-spendable shows 55,000, which is what it's supposed to show, isn't it? Okay? And I will debit the non-spendable. I'll credit the unassigned. So right now I've got a little bit of a funky situation in that I'm showing 45,000 in unassigned. Meanwhile, I'm only showing $55,000 of inventory up there, right? But don't I have to close that expenditure account? Don't I have to close the expenditure account? So when I close the expenditure account, I'll do what? I will credit the expenditure. I'll debit the unassigned. When I debit the unassigned, what happens? Now it comes to 0, doesn't it? So I'm showing 55,000 of inventory and 55,000 non-spendable fund balance, which takes me back to one of my first points, which is what? The balance sheet looks exactly the same under both methods. Balance sheet ended up the same, didn't it? Under both methods. The only difference is the income statement. On the income statement, on our statement of revenues, expenditures, and changes in fund balance, the purchase method is showing expenditure of 100,000. The consumption method is showing expenditure of $45,000, isn't it? So there is a difference in how we report that under the two methods. On the operating statement, on the statement of revenues, expenditures, and change in fund balance, there is no difference in how that gets accounted for on not how it gets accounted for, but how it's ultimately presented on the balance sheet, right? Question? Question? You're sure? Okay, good. Okay, so we can go ahead and close that. Then, if there's no questions, that's on Canvas. That same example's on Canvas. Okay, so let's go ahead now. Huh? Let's go ahead now and let's take a look at the closing journal entries. Okay, so we've kind of already gotten a look at the closing entries as related to that inventory example, but what I'm going to do to show you the closing entries is walk you through a sort of comprehensive, that may be over glorifying it a little bit, but a comprehensive example of some of the stuff we've already talked about so we can see how we're going to close things out. Okay, and that closing entry stuff is going to include accounting for encumbrances that are still outstanding at year end and how we will deal with those encumbrances that were outstanding at the end of the prior year and then become outstanding at the beginning of the second year. Okay, so that's the two things we're looking at now, right here. Right here, encumbrances of prior year and closing entries. We're going to do that all from something else that is on Canvas, which is this comprehensive example. Okay, so we're going to start here. Oh, come on. Oh, really? Beautiful. Okay, well, I'm going to have to write it in. Okay, so we're going to go ahead and start out with this example. And I just hope I can remember what it was now. Oh, no, I know what's wrong. I'm in the wrong year. I do want to start here. Okay, there it is. Okay, so we got 2 years. We got year 1, year 2. Okay, and I'm just saying it's 2014, 2015. Okay, but to establish the budget at the beginning of the year, and by the way, the highlighted journal entries are the budgetary entries. Highlighted in yellow entries are the budgetary entries, right? Okay, so at the beginning of the year, I debit estimated revenue, I credit my appropriation, 1.8 million, and I think I'm going to have a surplus. My budgetary control is going to be what? 200,000 here? Okay. Now let me see. If I bring up the screen, how well does that fit on the board? Looks like it wants to fit pretty good. Yeah, not too bad. You only have to read the wood there a little bit, right? Okay, to establish the budget, I have my beginning of the year entry up on this little part. Debit estimated revenue, credit budget appropriations, 1.8 million, credit budgetary control. Everybody seeing that? Okay. All right, good. Now what I'm going to do here is keep track of my budgetary control over here on the side, right here on the board. Bud control, and it just got credited for 200,000. With me so far? Just posting that in. This is not a sleepy time. This is fully awake time, right? Okay. Okay, good. So you go ahead and you do what? Why is this chair here? Here you go, as a footstool for you, okay? So we go ahead and we do what? We credit the budgetary control, don't we? Okay. Now what I'm going to do over here is try to put in an appropriations ledger. Well, that's not a good start. Okay, and in my appropriations ledger, I'll have my, no kidding, appropriation column. I'll have my appropriations column. My appropriations are credits, aren't they? Right? I'll have my encumbrance column. Encumbrances are debits, aren't they? Well, they could be debit or credit, depending on what's going on. Then I'm going to have my expenditure column. Expenditure columns are, the expenditures are debits, aren't they? And then I'm going to have the balance. With me so far? Okay, so these are columns here, and I'm going to go ahead and pick up that credit to my appropriation, which right now you're seeing kind of up on this part right here, the credit to appropriation, 1.8 million. How much did I credit to my appropriation? 1.8 million. And I'm going to sit here and go ahead and stick that credit to the appropriation of 1,800,000. Stick that in. That gives me then a credit balance of how much? 1,800,000 in my appropriations ledger right out of the gate. Right? Okay. Okay, good. Then what? Then I go ahead and I order equipment. And when you order goods, you debit encumbrance, you credit budgetary control, don't you? Huh? Okay, so I go ahead and I stick in that debit to encumbrance for 1,600,000, and now the balance in the encumbrance account is, in the appropriations ledger is 200,000, isn't it? So I could still spend 200,000 out of this appropriation, right? And not exceed my budget authority. Okay. Now I'm going to go ahead and I just credited budgetary control for 1,600,000, didn't I? Right? Okay. Okay, good. Then what happens? Then guys, I want to delete this because I changed this example. This needs to come out. Don't worry about that note. Okay, then what? Then I go ahead and I receive $1,100,000 of the equipment that I had ordered, what I had ordered it for, but the actual cost is 1.3 million. Can the actual cost be more or less or different than the amount I ordered it for? Yes, it can. So what do? I go ahead and I debit my budgetary control 1,100,000 because that was what I had originally set that part of my order up for, right? Was 1,100,000 what they're telling me? What? I set this up for 1,600,000, but not all of it has come in. Amounts for which I had encumbered 1,100,000 have come in at an actual cost of 1,300,000. So I reverse it for the original amount, don't I? Even though it came in different, I reverse it for the original amount. So I'm going to debit budgetary control. I'm going to credit encumbrances. Okay, so I go ahead and now I credit my encumbrances for 1,100,000. Putting that in the appropriations ledger. 1,100,000. For a split second, the balance comes back here to 1,300,000, doesn't it? For a brief moment. But then I have to record the expenditure for the actual amount, don't I? And the actual amount on this was 1,300,000, right? Was the actual? So when I go ahead and I now debit expenditure for 1,300,000, my appropriations ledger is showing me what? Showing me 0, isn't it? Now it's showing me 0 because what? I've spent 1.3 million of the appropriation in the expenditure, and I still have what? Another 300,000 of stuff that's sitting out there that hasn't come in yet. Okay. Okay, so I go ahead and I am now done with my transactions for the year. So I'm going to go ahead and I'm going to do my what? Do my closing entries. I'm going to do my closing entries. And so what happens here? I'm sorry, not another 300,000, but another what? 500,000 of stuff that hasn't come in. Not 100,000, because I did what? 1.6. 1.1 came in, so there's still what? 500,000 of stuff that hasn't come in yet, and I've received 1.3 million of stuff already. So that's why my appropriations ledger is what? 0, because I had a 1.8 appropriation, didn't I? And I've used it all up. 1.3 I've actually spent, and another 500 is spoken for, and I can't overspend that appropriation even for stuff that I've ordered. Even if it hasn't come in yet at this year, at the end of this year, I can't overspend, right? Okay, so what do? So at this point, I do my closing entries. And when I do my closing entries, well, actually, before I do my closing entries, can I make up my income statement real quick? Right here, my income statement. Revenues minus expenditures equal the change in fund balance of 700,000. Come on, guys. Revenues minus expenditures, a change in fund balance of 700,000, isn't it? Yeah. So I made my income statement. So I'm going to go ahead and I'm going to do my closing entries. I'm going to do what? I'm going to debit my, where'd we go? Right here, my closing entries. I'm going to debit my revenue, 2 million. Does that close that? I'm going to credit my expenditures. That closes that, and I have an unassigned fund balance of 700,000, don't I? Okay. Then what? This is very important right here now. I have to close my budgetary, my outstanding encumbrances, excuse me. I have to close my outstanding encumbrances. You must always close outstanding encumbrances, okay? And I have right now what? 500,000 outstanding encumbrances, don't I? The 1.6, 1.1 I reversed, and there was still 500,000 outstanding, right? So I go ahead and I debit budgetary control for 500,000 and credit encumbrance for 500,000. That's closing the budgetary entry. That's the same entry I would make if those goods came in, wouldn't I? Isn't that the same entry that I would have made if those goods would have came in? Same exact entry. I would have made that same entry if they came in, but they haven't come in yet. But I must close my budgetary entry accounts at the end of the year. Okay? And then what I do is I go ahead and set up a fund balance constraint because it's not unassigned anymore. I have made a decision as the managers of this government to order this stuff, haven't I? And when that's the case, we assign our fund balance. So I debit the unassigned fund balance, 500,000. I credit the assigned balance, fund balance, 500,000, don't I? Okay. Now, if you're sitting there and you're thinking about the unassigned fund balance, let's see what happened to it this year. Unassigned fund balance, and we'll assume we just started operations. Up here, I had credited it for 700, hadn't I? Over here, I just debited it for 500, didn't I? So what's the balance in there now? Balance is 200,000 unassigned credit, right? And I'm not going to tee up the assigned because it's just the one entry. The assigned is 500,000. Do I need to tee it up? Okay. I'll take that as a yes. Don't tempt an accountant to make a T account. The what? Assigned just got credited for 500, didn't it? Okay, and so what happens? When I look at the balance sheet now, I have what? Cash of 700,000. That was the 2 million of revenue, cash revenue that came in, right? Did I show you that? The 2 million of the cash revenue that came in. Debit cash, 2 million credit revenue, 2 million minus the what? 1.3 million of cash I spent that I paid for that stuff. So the cash is 700,000. Cash is 700,000. Just looking at the balance sheet, cash is 700,000. No liabilities in this case. No liabilities. My fund balance, assuming the beginning balance was 0, which we did, unassigned is what? 200,000. That 200,000 represents the surplus, doesn't it? I was going to get 2 million of revenue, and I was allowed to spend 1.8, so I was going to have a surplus left over. So that 200,000 is the surplus. The remaining what? 500,000 is representing the amount that's assigned for that outstanding encumbrance, right? That hasn't come in yet. Still out there somewhere. Stuff we ordered is in Kansas City. They ain't in here yet, though, right? Okay. Okay, good. Then I have to close my original beginning of the year budgetary entry. You always close this, don't you? At the end of the year. So you credit the estimated revenue for 2 million. You debit the appropriations for 1.8 million. That's simply reversing the beginning of the year entry, isn't it? And I go ahead and I debit budgetary control for 200,000. Is my budgetary control zeroed out? 1.8 credit, 1.8 debits. That's also closed out now. Question. Okay, good. Now we get over to the next year. And when we get over to the next year, our first job is to reestablish the encumbrance for the stuff that hadn't come in yet. We got to put that encumbrance back because we are waiting for that stuff, aren't we? So we put it back. We debit encumbrance, we credit budgetary control. We reverse the constraint on the fund balance. So we take the money out of what? Out of assigned and put it back into, these would have been better if these were on the same line. Put it back into the unassigned. I'm trying to credit that. That looks a little better. I put it back into the unassigned, don't I? So that 500,000 is back in the unassigned now? Okay. Then what? Then the stuff comes in. And when the stuff comes in, what do? We reverse the budgetary entry that we just put back. Because now the stuff is back, isn't it? So we reverse it out. And we put up the expenditure for the actual amount. Now, if this stuff came in for more than we had encumbered, what the government would likely do is say, okay, look, we need to use some of our 2015, in this example, year 2 appropriation to cover some stuff that's left over from 2014. They do it all the time. They simply program that money so that it can be allowed to cover 2014 expenses, even though it comes from the 2015 appropriation. Okay? And then all they do is when they report the expenditure, notice they label the year that it came from. And so 500,000 of that was 2014 appropriation, wasn't it? The remaining 50,000 to pay for this thing came from the 15 appropriation, we're assuming here. And of course, we credit the cash. Question. The example that you may have printed will look different because I didn't like some of the things I had going on in that other example. So I apologize if you printed that and brought it. Throw it away. Oh, did you fix it? Okay, well, put them on this. There was something I was doing there before that I decided I don't want to do anymore because it just created more harm than good. Question? Okay, so what we're going to do is start the Chapter 4 quiz. I am then going to turn you loose on it for homework, that you finish the Chapter 4B quiz. When we reconvene next time, we will go through that quiz in its entirety, and we will begin our midterm prep. Okay? Now, we've got a couple of classes in which we can go through left before the scheduled exam date, in which we can go through and we can practice with these practice midterms. And if you look on Canvas now, you should be able to see quite a few of them. Okay, let me put the screen back down. So if you look at, hang on guys, pay attention because then I get later on, where's the practice midterms? I didn't see them. You didn't put the practice midterms up. Practice midterms fall under the heading what? Practice midterm / final. And you can see that there's quite a few of them, isn't there? I'm thinking we're in really good shape to get through quite a few of these. So that the time we're walking into the exam, it should be a piece of cake for us, right? Okay, that's the game plan going forward. Okay? That's right. We're training you to be like the Marines. You're going to go in and have victory. Okay? Sound like a plan? Okay, so let's start to take a look at that 4B quiz. Of course, it's going to hide from me. Okay, so I'm going to go through maybe 4 or 5 of these, and then you can go ahead and you can work the rest of them on your own, and then we'll go through them together next time, okay? But I'm telling you, do not ignore this stuff until next Wednesday. If you do that, you're going to have to learn it all over again on Wednesday, and then you're going to be like, what happened? Because I'm just going to be firing through the questions. I'm going to be firing through the practice midterms, and that's where some people fall off the boat. Okay? The boat's going your way. Wait! And we're all going to be going, sorry, we can't turn it around. Here's some fish. Okay? All right, so let's go ahead and let's take a look at this. So the City of Kent's Police Department needs a new police car. A police car is ordered at an estimated cost of $34,000, and the appropriate budgetary control entry is made. When the car is received, the actual cost is $35,000. Which of the following is part of the budgetary entry that should be made when the police car is received? Okay, now both of these questions are exactly the same. I just screwed up and I put the same question twice. So let's just look at next to 1 and 2, the steps. First, you order the thing, you debit encumbrance, you credit budgetary control for $34,000, and somehow I lost my zeros over there. Okay, $34,000. Sometimes they do weird things with these. Okay, $34,000. Okay, then what? Then when the stuff, number 1, you can see it down here too. That's duplicate. You can see it down here. When you order this stuff, debit encumbrance, cover budgetary control. When the stuff is received, we do what? We debit the budgetary control, credit the encumbrance, don't we? And we debit the expenditure, credit vouchers payable for the actual amount. So is it true that when the goods are received, you would credit budgetary control? I mean, excuse me, encumbrances. When the stuff comes in, you credit the encumbrance, debit the budgetary control. Just checking you. Right? Okay, good. Number 3, which of the following is not a character classification? And guys, this is really chapter 2. This is really chapter 2, but let's just go ahead and practice with this. Remember, we put the different labels on our expenditures, and we could say that what? The period that it's going to benefit was a character designation. We had program, we had character, we had object class, we had activity. Remember all those things? Okay, chapter 2. Okay, remember I told you about my friend who's a police officer in the city of San Jose, and he hates the activity patrols. Remember I told you that story? Okay, so remember the rule in this class is if I tell you a dumb story, remember it, because you're going to have a question that's going to be relevant, right? Okay, so we come over and we say which of the following is not a character designation. Current will tell you that it's going to benefit the current period, right? Capital outlay tells you that it's going to benefit the current and future periods because it's for a piece of equipment, isn't it? What? Debt service tell you that it's going to benefit the current and future periods because if we borrow money, we should be matching that with some sort of longer term asset, whatever. We had that discussion. So what happens? Activity is not what? Is not a character designation. Activities are things like building inspection, patrols, that sort of stuff, right? Okay, we talked about that all in chapter 2. Okay, good. Number 4. A governmental entity uses encumbrance accounting. During the year the government ordered but had not yet received a new police car. What effect will these events have on the unassigned fund balance in the appropriate ledgers? Okay. Now, notice, guys, that I wrote up here a little appropriations ledger, and I just assumed some numbers. We got what? We got 100,000 worth of appropriation. We ordered the stuff for 45,000. And so the balance in the appropriations ledger came down 55,000, didn't it? Because the encumbrance was a debit. Okay. So I'm just showing you that what? The available appropriation does come down, doesn't it? Okay. But let's see how that impacts this question in terms of what's going to happen with the unassigned fund balance. Is that what the question's asking? What's the impact on the unassigned fund balance? That's what this question's asking, right? Okay. So let's go ahead and let's press this button one more time and see if this damn thing goes up. Okay. And let's take a look. So if I order goods like these, what is it? Police cars, okay? If I order these goods, what journal entry am I supposed to make? And let's just go ahead and use some numbers for this. What journal entry do I make if I order a police car? I debit encumbrance for 55,000. I credit what? Good. I credit bud control for 55,000. With me so far? Okay. Now the problem says during the year I ordered the goods but it had not yet received the new police car. What effect will it have on the unassigned fund balance? So what am I supposed to do now? I come to the end of the year, the stuff isn't here yet. I call them up, I say, hey, where's my police car? They say, sorry, it's on its way. It'll be there in March. What am I going to do? Arrest them? Okay, so what do you want me to do now? Good. I reverse this as though the stuff came. There's the pen with some ink. As though the stuff came in. So I go ahead and I debit budgetary control for 55,000. I credit the encumbrance for $55,000, thus closing my encumbrance, right? The encumbrance has to be 0 at the end of the year, doesn't it? The budgetary control has to be 0 at the end of the year, doesn't it? Are they 0? Are they 0 now? Now I have to do what? Good. I have to set up the what? Assigned fund balance. So I'm going to do what? I'm going to debit the unassigned for $55,000 and credit assigned for $55,000. Now, guys, I'm crediting assigned here. I'm going to tell you something right now. It could also be committed. Now, you sit there and you say, but I thought committed was outside and enabling legislation and all that. But if I've ordered something that I can't send back, then it's committed. Because now I have an outside commitment, right? For example, I'm going to order a Tesla. And Tesla says to me, no problem, sir. We'll order you a Tesla. What color do you want? Black? And I say, no, I want fuchsia. I want a fuchsia Tesla with yellow interior. And they say, well, geez, we don't really have any of those. I say, I don't care. Do what you have to do. Go find me some pink. Go find me some yellow. Make the thing. So they go and they start making the thing. You think they're going to think it's too funny if I turn around after that and I say, oh, you know what? Actually, I don't want pink. Can you do blue? They're going to say, oh, hell no. You're taking this thing, right? Okay? So if a government orders something to very specific specifications, I'm not going to win a Pulitzer Prize for that, for very specific specs on it, then they're stuck with it, aren't they? So that money is considered committed. If they've ordered something that they can easily send back, example, I ordered my dad his recliner broke. He couldn't put his feet up. This is when he was living by himself. He couldn't put his feet up. The doctor said he's supposed to put his feet up. So my brother kept saying, I can fix that. I can fix that. I can fix that. Finally, my dad's feet are getting this big because he's not putting them up. So I'm like, okay. So I go over to Macy's and I order him a recliner, right? With the automatic electric thing and all that kind of stuff. And so I call my dad and I say, hey, I ordered you the recliner. Next day, my dad calls me up and says, what? Guess what? Your brother came and fixed the recliner. I love it. I don't need this. Oh, God dang. So I call up Macy's and I say, can I send that recliner back? No problem, sir. Because what? It wasn't a recliner that I said, hey, it's got to be this, it's got to be that. It was something they had in stock, right? So if we've ordered something that we can easily send back, then it's more in the assigned category, isn't it? Okay. Now I don't want to throw the baby out with the bathwater. The journal entries to debit the unassigned and credit what? Credit the assigned, right? Fund balance like we saw in the example. Okay. So as a result of this transaction, is it true that what effect will it have on unassigned fund balance in the appropriations ledger? In the appropriations ledger, my what? Unassigned appropriation came down, didn't it? My unassigned fund balance decreased. Isn't that true? I saw one time on Rate My Professor. Be careful if you take Lord's class. You really got to know your stuff if you want to get an A. No kidding. Okay? Thank you for that one. Although it had a big red frown face next to it, okay? I stopped looking at Rate My Professor, by the way. I don't look anymore. So if you want to get at me through that, you're going to have to find another way. Because I don't look at that. Because we used to have like this thing, oh, he's hot, you know. And then all of a sudden, that went away. So I'm sitting there and I'm like, oh, my friends are like, what's wrong? Nothing. And I'm thinking to myself, I'm not hot anymore. What happened? Okay, all right. So anyway. Okay, so it was like defining my self-worth. So I stopped looking at it. It was driving me nuts. Okay. Now, anyway, so my point in that story is you got to know your stuff, don't you? I mean, that's knowing your stuff to be able to answer a question like that, right? You can't just walk in and say, okay, this is now. This one is a little more straightforward, okay? A public school district budget estimated revenues of 800,000, approved appropriations of 780. Which of the following is the appropriate entry to record the budget? Debit estimated revenue what? 800,000. Credit the appropriation 780 and credit the budgetary control for the difference of surplus, right? Okay, so, we won't make the questions too difficult like this one we just looked at before, but, you will have some like that, so you have to know what you're doing, right, to be able to answer these, okay? All right, so my advice at this point is to go back through the slides, go back through the 2 examples that we did, pick up this practice quiz for 4B, go back through it, work back through it. We'll reconvene on Wednesday next week. We'll knock the rest of this out, and we'll start chopping away at those practice midterms, all right? Make sure you signed in, guys, and we'll see you next time. Please make sure you signed in.